Hey YouTube, what's going on? It's Patrick here at VectorVest, and today I've got one of the most important charts that you need to be aware of over the next few weeks. So if you're ready to make sure that you stay on top of the markets rather than getting caught off guard, and to make sure that you're ready to profit from the markets no matter what happens next, make sure to hit that like button, hit that subscribe button to keep up to date with all the content we have coming out for you, and let's get into it. Alright, welcome back. So, before we jump into the highlights here today, I just want to give you guys a little bit of backstory out there to get the mindset of where I'm coming from on this one. So, with the last few days, we've seen a lot of fear starting to build in the market, and you have markets hitting all-time highs, you have new investors coming into the market, so retail is one of the biggest movements in the market over the last few months, and those are typically ominous signs of some sort of a correction. So with that, I started thinking. I wanted to do some digging to find out where exactly is all this fear coming from, and is there really any reason for this fear based off the charts and what we see in the markets right now. So what I've started doing was pulling up all the major indices. At the top, you can see the Dow, NASDAQ or the QQQ, SPY, and IWM for the Russell. These are all the ETFs on the major indices and not the exact index themselves, but they work the same way and they can give us the same kind of analysis. So I started off taking a look at the best 500 companies in America, the S&P 500. Looking at the chart, everything looks pretty solid. You have a nice steady rise from bottom left to upper right, price just pulling back a little bit off the new all-time high. And on a short-term basis, the 3 and 8 exponential moving average still in bullish territory. DPO still shows that it's moving up nicely. Stochastics does show us that it's overbought right now, but not to be unexpected. And as we always know with stochastics can stay in overbought territory for quite some time. So just because it's in that territory right now doesn't necessarily mean it's a bad thing. So I looked at the S&P 500. Everything looks pretty good. I went to the NASDAQ next, the tech index of the market. Same situation. Nice rise from bottom left to upper right. We saw that pullback here right around March, but quickly came right back and taking out that previous high, hitting a new high here. On a short-term basis, the 3 and 8 exponential moving average are still bullish, so that's a good sign. DPO, stochastics, basically the same we saw with the S&P 500. So then I went and took a look at the Dow, the more conservative index, if you will. Well, nice steady rise in price from bottom left to upper right. Barely any volatility throughout the last year. And same situation we saw with the other two major indexes, the S&P and the NASDAQ. So 3 and 8 are still positive. The DPO is still in positive territory as well. Same as stochastics. So then I thought, okay, well, the 3 major indices all look pretty good right now. What about the Russell 2000? So I went and I pulled up the IWM chart. Well, we have a nice steady rise from bottom left to upper right, but stochastics are starting to sell off, coming down towards that oversold territory. DPO is just going into negative territory. And then looking at price action, we get a way different story from what we saw with the other 3. Now, if you're new to the markets, you may be asking yourself why this is important. Well, historically, the Russell 2000 is more of a leading index, if you will, because when the markets are starting to do good, the small cap stocks start to rally. They outperform the macro stocks or the high cap stocks or large cap stocks. And that's because investors are willing to take more risk. The Russell being a small cap index for the most part, small to mid cap, is really a good indication of investors' sentiment on the amount of risk they want to take. Well, knowing that now, looking at the chart pattern, we start to see an ominous pattern appearing here that nobody else out there is talking about, and we really need to bring it to everybody's attention so that way you guys can pay attention in the next few weeks to see what happens, to make sure you're on top of things rather than being like the typical retail investor that gets caught off guard and then ends up being the bag holder. So if you want this kind of information on a daily basis, make sure to click on the link in the description below where you can sign up for a free trial of VectorVest, and we do this nightly recap for you right there in our software to keep you on the right side. We've done it for over 30 years. And if you want to make sure you get this kind of information on a regular basis, join now, click on the link, sign up for the trial if you haven't already. All right, so with that in mind, let's take a look at the analysis I'm referring to. So looking at IWM, or the Russell 2000, we see a nice steady rise, but realistically, since about the middle of February, we've started noticing one of the most common reversal signals, or most common chart patterns, or most reliable chart patterns showing up on the Russell. So taking a look at it, doing a quick run through together. We had a nice run all the way up until about mid-February. Then we started seeing it pulling back, took off to a new high, pulling back, creating a double bottom, and now potentially creating a new shoulder here, which would lead us to a head and shoulders pattern. To demonstrate that, I'll use the freehand line and just put some nice pretty lines on the graph for you guys out there. But here would essentially be the upper part of the shoulder. Here's the bottom part, or what's referred to as the neckline. And the reason why this is so important is because typically head and shoulders are a good breakout pattern that can lead to strong market rallies. One of the other ways that head and shoulders can be used is a reversal signal from being bullish to bearish. And to prove that point, I'll simply pull up Investopedia.com, which is a great free resource that everybody should definitely be using at any time. Even I have VectorVest and I still use Investopedia. But for now, I just want to focus on the key takeaways. And that is, a head and shoulders pattern is a technical indicator which a chart pattern described by three peaks. The outside two are close in height and the middle is the highest. A head and shoulders pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. This is the main thing to take away from this key takeaways here. And it's also one of the most reliable trend reversal patterns. So just to kind of highlight the last two, those are going to be where we're going to be focusing on here today. Here's just kind of reiterating it in a little bit more detail for you guys out there. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns, and it's one of several top patterns that signal with varying degrees of accuracy that an upward trend is nearing an end. Well, let's go back and take a look at IWM's chart. Ever since the lows of March last year, we've seen a really nice upward trend in the Russell 2000. People's risk appetites have been high, especially with retail being at home, trading online, finding something to do with their free time. People's risk have been extremely high, and that's helped the Russell really take off. But after that nice long upward trend, we're now seeing that head and shoulders pattern forming right now. And this could be that reversal of the overall Russell, which is a leading index. And that could lead to the Dow, the NASDAQ, the S&P that all look rosy right now. That could lead them to also starting to see a decline as well. So regardless of whether you're a aggressive short-term trader that's trading small and mid-cap stocks, or you're somebody buying the best 500 companies out there, this is important for all of you to be focused on and keep an eye on over the next few weeks. So what are the two things that you want to look for to see which way this chart pattern is going to head, or get some ideas on how to really put this chart pattern into practice for you? All right, so going back into it, we'll zoom in now that everybody has a pretty good idea of what we're talking about, what we're looking at. Let's go ahead and identify the two key levels that you need to be aware of. So the first one is looking for a breakout, which would be a very bullish sign and tells us that people's risk appetites are back on, and then we could see the markets continuing to rally, is a breakout of the shoulder line here, which roughly is about 227 on IWM right now. You could give or take a little bit here or there, but at over $200 a share, that's a good enough indication or a good enough level for me to get a good idea of where that breakout could potentially come from. So that's where you're looking if you're bullish, or if you want to reload into new positions and really help jump on board a potential rally in the market early enough that you're beating most of the other retail traders out there. This is the level you're looking for, is a breakout of the shoulder pattern or shoulder height right here. But here comes the negative sentiment. And I don't like being negative. Being from VectorVest, our founder, Dr. DeLito, taught me many years ago, it's better to be an optimist than a pessimist because the market tends to go up more than it goes down. So I tend to not like to be bearish, and I don't like being bearish, especially in the videos here. But this is definitely something that needs to be put out there, and you guys really need to focus on because it could help save you a lot of money, especially all the new retail traders out there that may not be familiar with this type of technical analysis. So the one thing to keep an eye on, and the one thing that would really throw off the alarm or throw off the caution lights, would be a breakdown of that neckline, which appears to be right around, let's say, 210s. My line's at 209.40, but 210s somewhere in that ballpark would totally be acceptable. If we break below that neckline, that would show an impending drop or impending correction coming in the Russell. And since, once again, the Russell is considered a leading indicator, that could also lead to the Dow, the Nasdaq, the S&P also following suit. So this is kind of like the early warning sign in the market. Now, technical analysis can be wrong, and we could see a breakout to the upside, the market takes off, everything is back on, everything looks great. But if it does break down, this would most likely happen before we see the other three major indexes start to break down as well, and give you an early out or help you tighten up your stops on your positions to make sure that you're locking more of your profit in than you would be if you were just following the talking heads on TV. So to recap, we have a head and shoulders on the Russell after a long rally in the market. This is typically known as a reversal pattern and not a bullish pattern. If we break that low of around 210 on that head and shoulders pattern, expect to see that not only the Russell continues to drop or goes into correction territory, but expect to see the other major three indices following suit as well. So if you guys like today's presentation, let me know in the comments below your thoughts on the head and shoulders pattern. If you guys have ever traded it before, how successful it was for you, or what you guys see with this. If I'm wrong or if you guys see something different with this, let me know in the comments. Let's have a discussion about it. And I want to know, where I'm wrong. If I am wrong, where are my holes? What am I missing? But for right now, from what I see, this could be an early warning sign, and I want to help you guys out and keep you all protected in your positions and allowing you to be able to become financially independent by utilizing the markets and by trading successfully. So on that, I hope you all have enjoyed today's video. Share this with your friends, share this with your family, get this information out there because this is something nobody else out there is talking about, but it needs to be addressed, and it needs to be addressed soon since we're on the last shoulder potentially of that head and shoulders reversal pattern. So until next time, take care, adios. I'll see y'all on the moon.
Yeah.